Okay. Okay. Welcome, guys. Little Thursday night webinar, Thursday afternoon webinar, even. I got a pink cup, and I'm here for serious business. So should be a good time. Nice to see you guys. Good to be with everybody. Janae, NFP, yeah, non-farm payroll. So it's just all the, yeah, there we go. Yep. So I guess that's non-farm related work, because maybe farm related work is too steady or something. People get laid off at farms. I mean, does that not happen? Maybe they don't. Maybe they do. So anyway, it's just the job numbers, just the monthly job numbers in the US. How many jobs are created? So we have weekly unemployment numbers, which is how many people are applying for unemployment benefits. And then we have monthly employment numbers, how many jobs are being created. So it's all about job creation, right? How many jobs are there that weren't there the previous month? Okay, guys, the thing that I want to talk about today is as follows. I've had a lot of questions about this over the last week or two. I don't think we did a webinar last week. Did we do a webinar last week? I don't think we did. Yeah, Lenny, should be non-server farms payroll. But if we missed the webinar last week, which it sort of seems like we did, I can't remember. I wanted to give everyone a little bit of a chance to catch up on the past two webinars from the 2 weeks before, right? Which were number one, let's talk about what these are here. So number one, the last two webinars, and if you haven't watched them, go back and watch them. Go back and watch them. Number one, we talk about, well, we talk about two things, right? Number one, we talk about the cost reducing trade strategies. And there's 3 of them. Yes, so that was a webinar. And then we talk about how to own stock for frizzle. Oh, for free. There we go. So those are the two big things that we covered, and they're actually probably some of the most important material of what we do in this group. So if you haven't seen the past two webinar recordings, which would be, I don't know what the dates are, but around mid and early April, somewhere in there, go and look at this stuff, because this will be so important, so important. Our cost reducing trade strategies and how to own stock for free, right? This is really the, the intense part of what we're doing in all of this. So yes. Thank you, Mel. Good. Glad you found the last two good. Yeah, and even if you've watched them, definitely watch them again. It's so important to really have a good, solid understanding of these concepts, because what I want to talk about is, to kind of go in line with some of this stuff. I want to talk about a third important element here, right? Cost reducing strategies, great. How to own stock for free, great. By the way, I was reading this book about how to position yourself in your industry the best possible, and it was kind of funny because I look at some of the things that we do in our trade group, right? And this, and maybe you guys can correct me if I'm wrong here, or I mean, please do. I was reading this book, and it says, okay, if your industry has jargon, you've got your own buzzwords and keywords, number one. Number two, if you can just talk about your basic industry like it's nothing, and other people have no idea what you're talking about, then you're starting to be in a situation where you should position yourself to share information with others, right? And I thought, boy, that is option trading to the max. I talk about some of the strategies that we do, and we just do it, right? It's easy peasy. And as new people join the group and they say, I have absolutely no idea what we're doing in this group. This is beyond even a point that I even think I want to learn what we're doing. And I think, oh, it's a piece of cake. It's a piece of cake. And you guys probably think the same thing, right? It's a piece of cake. It's a piece of cake. No problem. This is all easy stuff. But remember, people that are coming to this for the first time or two, it's so just out of the realm of normal stuff, right? Most people get caught up when we're talking option trading. They get caught up on things like selling options. How do I sell an option I don't own? First major pitfall of understanding trading. So I basically bring that up because it really made me think of trading. And it's something you guys might want to think about as well. You guys, without knowing it, are becoming experts in a fairly complex industry. And it's only taken a year or so to get there, right? I mean, that's kind of impressive. That's kind of intense. How many of you feel like you're experts? Show of hands. Let's say it, guys. I mean, you guys have done some good stuff. The questions I get in the chat and so on lead me to believe that you guys have a very, very good understanding of all this stuff. So it's really, really, really cool. And I, by means, in terms of, do I know everything about trading? Of course I don't. I don't know everything about option trading. I have become comfortable in a place where I don't care about the stuff that I don't need to know. And I don't honestly even know all the stuff that I don't need to know, but I know that I know enough to be consistently profitable in what we do. I think that's where you're kind of in that expert status. So you guys are all doing just an absolute bang up job. Mary, you're getting pretty darn close to it. Expert, no, I don't feel helpless anymore. Lenny, that is big progress. That is big progress. That's great. Yes, exactly, Janae. Yep, you know more than you did a year ago, and more than anyone that you talk to, knows, right? And that's a good thing, right? That's such an important point. I don't mean to get off on a total tangent, and I'm going to go for 30 more seconds, then I'll get on topic here. But that's such an important point, guys, of, when I talk to people about trading, when I talk to them about stuff, especially people that are, either in the trade group or thinking about joining the trade group or whatever it may be, people will tell me, and Janae, it's such a great comment you make, because people will say, oh, I'm really busy. It's going to be a busy year for me, right? Which obviously, that automatically tells me that's a person that has a hard time prioritizing their time, which I'm one of those people, right? I have a hard time prioritizing my time. But people say, oh, I have a busy year ahead, right? But the thing is, as Janae has said, Janae, you could have done nothing with trading and continued doing all the things that you were doing, and I know you stay very busy, and you would be just 1 year further into life, 1 year older, 1 year wiser, 1 year whatever, right? That year was going to pass regardless. But in the last year, you've picked up this trade, this skill that has, and I won't obviously say the specifics, but I know how much money you have made in the last year in our trade group, and it is not a small amount. So you have made a lot of money, you've picked up a new skill, and the year was going to pass regardless. So you guys are in the right place, doing the right thing, and that's awesome. That's really amazing. So don't shortchange your guys' knowledge and ability, because it's probably a lot more than what you think it is. Okay, so that's very cool. Glad to be with you guys. Let's get a little bit down to what I would consider probably an important element of option trading. I want you guys to think in these kinds of terms. We talked a little bit about this last week, but I want you to think in terms of income producing trading, right? I love the saying, let's hope the outcome is income, right? and that's our goal, right? Can we make this whole thing profitable, right? Now, of course, as I mentioned, Janae and many others whose accounts have grown. I mean, has anybody had Janae, I've seen your account. Has anybody else had a successful experience with us? Have you made some money being in the trade group, following our trades? Has it made you some money? Has anybody here made some money following the trade recommendations? Good. So now, good, excellent, very good, guys. Good, glad to see it, glad to hear it. So now what we have to look at is how do we make this income producing? How do we make this the stuff that Mel, I wish we were at 100%. We've lost a little bit of money on some of the call options we bought. I think we've had two or three losing trades, probably some of those call options. But so we're in the high 90s, I'd say, somewhere in there. But we're doing good. We're doing good. And for everybody that's just doing what I'm recommending to do and following my trades, it's interesting that you bring up, Lenny. You know, you said, yes, it's the non-group trades that are dragging the account down a little bit. I've had this discussion with a few people as well over the last couple of weeks saying, you know what, my account's not growing as much as I think it should grow and so on. And then I see all the other activity that people are up to, right? And that's okay. This is not a only do my trades and do nothing else. But just realize if you do my trades and you do something else, your results are going to be very different from my results. They could be better, they could be worse, right? But we know we're kind of on a pretty good track here that we're making very consistent, profitable trades. I was telling somebody, I managed some money for someone, and so I get together every couple of weeks with this person, and they're not ultra computer savvy. And so, I just say, let's get together. We chat about how their investment with me is doing, and I help them put trades on their account, once or twice a month, right? Once or twice a month. And this is kind of an interesting concept as well. And I promise I'm going to get back on track here. But this person's account, which is a decent sized account, is up 70 or 75% in the last, 7, 8, 9 months, somewhere in there. And I'm the only one that puts trades on that account, right? But we get together so infrequently. I mean, it's every 2 or 3 weeks we'll get together, and I just look at the trades, and then we talk about what I'm doing with this person's money and so on. And their account is up a ton, and it reminds me that probably I am being too active and too involved in my own trades. If I step back even more than I do, and I know that I'm much more reserved than many of you guys are. A lot of you guys are doing a whole bunch of different things and all that. And you're seeing that your results are not as good as mine. And the funny thing is I'm seeing that my results are not as good as my results on somebody else's account that I can't get access to more than twice a month. So, I mean, it's something to think about, right? Sometimes in this industry, less is more. Less is a lot more, right? I go back to the fact that in the trade group, we had multiple trades in the teens on Alcoa. We were buying and selling Alcoa at 12, 13, 14 bucks over and over again. And here's Alcoa at $40, right? If we would have just bought Alcoa and literally had amnesia and forgot we had it and we did nothing else, we would have made a whole bunch of money in Alcoa. So sometimes a lot less is very effective and good for the account. But we're going to talk about how to do a lot more. And I don't know if that's going to be good. No, not a lot more. We're going to talk about doing what we're doing, but a different way to look at it. So income producing trading, as opposed to income producing trades, every trade that we take, we hope to make money on, right? Every single trade we're saying, I want to make money. That's why I'm doing this trade. Obviously, we're not doing a trade where we're saying, hopefully we lose money on this. Now, we do hope that stocks go down. Oftentimes we put bullish trades on, but we never hope to lose money. So income producing trades are a given, but income producing trading, right? How can we start to visualize the numbers that we need to visualize to say, okay, I want to make some money. And I just want to, I don't want to, it would be nice to make $1 million. It'd be nice to make a couple $100,000 or $100,000 in my account this year, whatever, that's all good. But what if we break it down into some smaller steps? in the last webinar we did 2 weeks ago, I said, this is how you own stock for free. And that's one angle to look at all of this, owning stock for free, pulling all of our money out of stocks. The other angle is to own stock and to use that stock that we own as our low risk safety net kind of situation, right? Which means we now are able to take very low risk trades, decent high paying option premium trades with very little risk, right? If we own stock, then we can sell covered calls, we can do all that kind of stuff. Okay, very, very good, excellent. So we've talked about the strategies that we use to lower our costs, but let's just go over here and let's look at X. X is a good little example. X, of all the trades that we have, X is a good high-paying stock as far as option premium goes. It's a good high-paying stock. And so we like that on the option premium side of things because we need to make the most amount of money, right? I think, and I've said this in the past, I think that CLF will probably maybe run higher. I think CLF may be a better company than X, but X probably pays more. Well, X does pay more money, and CLF probably will be a better company. So CLF will probably make up in stock appreciation where X will pay out in option premiums, right? So if we just look, for example, kind of my typical go-to, if we say, okay, what's a 1 week, next Friday, what's an at the money call option selling for 1 week out? Here's X basically trading at 26 bucks. 1 week out, we're getting about $1 out of that, right? 1 week out, getting about $1 out of that. CLF, 1 week out at the money. We're doing okay. We're doing okay. We're getting about 70, 75, 80 cents out of that. So we're getting a little bit more and kind of, in good comparison, but the further out of the money we go, like selling a call option out of the money. So if I go, here's at the money, if I go 1, 2, 3, 4 strikes out of the money on CLF, I'm getting 20, we'll just call it 23 cents, 23, 24 cents. I'm getting almost 25 cents here. How many strikes did I go out? Okay, 4 strikes. Let's go over here to X. If we go 4 strikes out of the money on X, 1, 2, 3, 4, we're getting, almost twice as much, pretty darn close to twice as much. So those are some things to think about. The stock price isn't significantly different, but volatility and all that will help this to pay more. That's a good point, Erez. That's a good point. Okay, so what I want everybody to kind of think about, let's say that you own a bunch of shares of X, right? Now, think about how much money is in your account, right? In this account, my net liquidating value is $9,500, right? Got $9,500 here. So, so in this case, with my $9,500, how much stock could I own, right? If I had no other positions, I closed everything else and I just had $9,500. So the question would be, obviously we're trading on some margin here, and let's just look at X and let's just say that how much will it let me? It's going to give me, not enough money, but okay, let's go. My $9,500, let's see if I go to 600 shares of X. That's going to tie up about 70, just shy of $8,000, right? About $7,800. So I've got about $7,800 tied up of my 9,500. If I had no other positions open, I could put on, how many shares do we have? 600 shares. 600 shares. I'd be tying up about $7,800 with 600 shares of X, right? Okay. So we look at that right there and we say, okay, with 600 shares of X, I'm going to be tying up that much, $7,800. And if I just, let's say we go something real basic, right? Let's say that I'm able to sell I'm able to sell a strangle, a 1 week, 7, 8, 9 day expiration. And I sell this every week, essentially. If I do about an 8-day expiration, I can probably do this about 3 times a month, right? We're going to have some weekends, some downtime that's going to be eaten up, some non-trading days. So I should be able to do this pretty close to about 3 times a month. So if I do this 3 times a month, which is great, then, and let's just say I go with like, let's say I go two strikes or 2.5. Well, we'll just say 2 strikes. I'm going to do a 1 week, 2 strikes away strangle on X, right? And that's going to pay me about 75 cents. But keep in mind, it's going to lower my break even by 75 cents. But keep in mind that I have 600 shares, right? So now I'm doing 6 contracts. How much? Whoops. That's going to tie up the rest of my account, basically to the penny, right? So it's going to cost me around $2,000 to have 6 strangles on X, and I'm tying up around $7,800 on my shares of stock. So, I might have to do 500 shares, or I might need to put another $500 in, whatever, right? Let's go on a kind of $9,500, $10,000 account. So I should pretty easily be able to sell buy 600 shares and sell 6 contracts worth of strangles 3 times a week. Or 3 times a month, sorry. So that's going to make me $462. Now my break even's only lowering by 75 cents, but keep in mind, I am producing about $462 every time I do that. Can you guys see my calculator? Everyone see the calculator? See the calculator. Okay, so if we do 462, and if I can do that 3 times a month with about a 1 week expiration, that's going to produce for me about $1,386 a month, right? And let's say that I have a $10,000 investment. So if I just have shares of that one stock, which is obviously not very good on the risk adverse kind of situation, but even if this stock goes down considerably, we don't really care. We're just going to keep selling options on it. We're going to keep selling options. Now, there's going to be times where, maybe the stock gets called away and we got to get back into it. If the stock gets called away, that's going to be a pretty significant gain for us, by the way. If the stock were to get called away and we own this at $26 and it gets called away at $28, not only am I going to get my, $462 on that trade, but I'm also going to get $2 a share. I'm going to pick up another $1,200 from stock appreciation, right? That's where did I get $1,200? Yeah, right. So I've got 600 shares. This thing's going $2, and I'm picking up $2 times 2 times 6. So I'm getting $1,200 extra dollars there. So then that turns out to be a $1,662 gain from that strangle and losing my stock, and then just having to get back into it, right? So something like this is something to think about. Now, I don't know what the math is. What do we say? 1380. What did I say? Was it 1386? Well, let's go back to it. What are my numbers here? I'm forgetting all my numbers. 462. So 462 times 3 times a month, 1386. And 1386 of, say, a $10,000 account is around 13 or 14% a month that we're making on our account from doing one thing 3 times a month. And we can start looking at these kinds of things. And especially, this is on a $10,000 account, by the way. If you have a $50,000 account, if you have a $100,000 account, and you just say, well, I'm just going to do this, and I'm going to do it with this many shares, and you're making $1,386 a month, you have a $100,000 account, great. You're taking literally no risk. You could do it with 1,000 shares, right? So what if we do this with 1,000 shares? And we say, okay, and of course, you have a little bit of a bigger account. Maybe you want to do 1,000 shares on this, and we're picking up, now we're picking up 770 every, we'll do that about, however many times, 3 times a month. So now we're pumping out about $2,300 a month from just selling a strangle on a stock like X. And we're doing it over and over and over again. And it just is making us, crazy amounts of money. If you did this, let's say you had a $100,000 account and you did that every month for 12 months and you produced $27,000, that would be almost a 28% gain for the year, with taking very, very little gain or very, very little risk for that size of an account. And it would just be producing you an extra $27,000 a year for, on a medium-sized account, on a smaller account. Certainly on a larger account, it's going to be a little less significant, but you just increase shares, right? You can do that kind of stuff. So I want people to, we talked about looking at it in the way of, I want to own stock for free. So I'm going to sell options and sell premium as much as I can so that I can just bring the price of my stock to zero. And I love that on so many levels, because what that's telling me is, if I buy US Steel at $25.96, which I'm not excited about, if I keep selling options against that, I can bring my price down to $15. I can bring my price down to $10. Awesome, right? And then US Steel just keeps going and we just keep making money and everything just keeps rocking and rolling. And I love that. But if we want to look at it in the way of, well, I'm going to buy stock and I'm going to own stock, and hopefully the stock will appreciate, right? Hopefully the stock goes up. So this, $13.86 I'm making every month on a $10,000 account or whatever, hopefully on top of that, the stock that I have is worth more every month, whether it's $1 more a share or $5 more a share or 50 cents more a share. Hopefully it's going up a little bit every month, which US Steel has done, right? We've traded it plenty of times in the teens, and here it is in the mid 20s now. So US Steel has been going up steadily. So if we can do that, and we can produce that income from the option side of things, that we're just making steady money out of it. Money that is now starting to cover your mortgage, right? Money that's starting to get to, hopefully you have some time to kind of pad things a little bit. And you can say, okay, I've padded my, I have a year to do this before I want to pull any money out. So then you can add, what did we say that 1386, which is, this kind of $10,000 account example, times 12 is $16,000. So I can 1.5 times my account in a year, right? I can add $16,000 to a $10,000 account just doing this strategy over the course of the year. That's 150% return, by the way. So that's awesome. But that gives us a big padding. So now your, $10,000 account is worth worth $26,000. So if you have a couple of years to do this over and over again, then this is how you can start looking at this in the way of, now I have an income producing asset. I'm now pulling out, I now know how I can make regular income from the stock market in a pretty predictable way. And remember, any points that we lose the stock, we just can't find a good way, like may happen tomorrow. We just can't find a really good way to get out of the stock, and we have to get the stock called away. That's a big gain for us, right? That's like 1 month of gains in 1 week, because we get called away, and sure, we have to get back into the stock at a higher price. We don't really care that much. We really don't care that much, because everything that we're doing is adding to lowering that break even. So we're going to continue selling options against this kind of stuff to produce some sort of predictable income. Does that make sense? Okay, we have a lot of comments and questions. Let me get over to these real quick. Okay. Eras, yes, you could sell a naked strangle. I never would or will, and you could produce a lot more money from that. But the reason I like to have stock involved is, A, it takes massive amounts of risk out, right? Huge amounts of risk. And B, the stock is appreciating, right? So we're making money on that. I mean, hopefully it's appreciating. So we're making money on that stock, and we're taking the risk out. So yes, you could sell a naked strangle, and there's plenty of option. Don't get me wrong. There is a million great option trading strategies that don't require owning stock and don't require tying up a bunch of capital. 100%. What I'm trying to do is produce something that is a fairly consistent return with as minimal risk as possible, while, and again, owning stock is not just to reduce risk, but it is also to have an appreciating asset, right? We're making money on an appreciating asset. It's kind of like owning, a vintage Rolls Royce that there was only 200 of them made, and you get to rent the car out, but nobody actually uses it. Awesome, right? That's the kind of thing that we want to do in this whole thing. Okay, Jamie, could I do something like this with my IRA, or how would you do that? Lenny, yes, you can, but you can't trade on margin, so you'd need actual money in the account. Yes. So, and that's a good point. So remember, this kind of a strategy, to do this exact same kind of thing and get these exact same kind of numbers, you would probably need almost 3 times as much in an IRA account. Because IRAs, not only, in a stock account, we get basically 2, or in an individual margin account, you get basically 2 to 1, right? You pay about half of what the stock cost. And that's fine. But in an IRA account, they really stick it to you on the options. When you're selling a naked, just look at this, for example. I'll show you an IRA account here. So if you look at, well, we'll just go one contract, right? Let's go one contract. If I sell a strangle on X, 28 and 24 on a margin account, that's tying up $316, right? So keep that in mind, 316. I'm going to type that in here. 36, whoops. Oh my gosh, I'm hitting every wrong button. Oh my heavens, 316. Oh, good heavens, there we go. Okay, so I'm tying up 316 bucks. If I go over here and I look at a margin account, or sorry, an IRA account. So here's some IRA money, and if I look at X, and that same thing, right? Let's just do all the same stuff, 28 and 24, I think, right? And I do a strangle there. There's all that same premium, 70 some, $2,500, right? That strangle cost me $316 on a margin account, and it's costing me $2,300 on an IRA. So that's where things change up a bit, right? That's where so on the IRA account, the stock is not changing that much. You're paying twice as much for the stock, but you're paying like 10 times as much for the for the short puts. So for those that do want to trade an IRA account, this kind of a thing with probably just covered calls. You make less money, but you can still make, IRAs are just kind of tough. We have restrictions and all, and I'm going to think about this a little bit more with IRA accounts. I've kind of thought about this a little bit more on the side of individual, on margin accounts, how this can be done with money that is just, because the other thing that you want to think about as well is in an individual account, when it comes time to start taking money out of this and making this producing income, of course, we're going to have some tax, some tax bills attached to this, and that's always the other side of it. But with an IRA account, unless obviously you're of the age where you can be pulling money out and so on, your money's going to be locked in there. We want to kind of think of this in the way of, I want to start taking money out of this, whether it's quarterly, I want to take my profits out quarterly every couple of months, or every 6 months or whatever. And that's always, of course, a little bit tricky on these, on these IRAs. So I'm kind of thinking about this more on an individual margin side of things. But if you look at this and you say, okay, I own, 500 shares or whatever, and I'm just going to keep selling covered calls on X, right? And I'm going to put it $2 away. Here's X. I'm going to sell a covered call on this, and I'm going to make, I'm going to make less money because that's just what I have to do. And so, we're making 40 cents instead of 70. So, it's definitely less. But you can also just say, well, maybe knowing that this is an IRA account, I'm going to put my strikes closer, and I'm going to get a little more premium, and I'm also going to risk the stock getting called away. and you just keep buying this thing all the way up, and you keep getting it called away. You buy it weekly. And if it gets called away, you buy it again and buy it again and buy it again, right? There's that side of things. There are, there's ways to do this on an IRA. And I need to think about it a little bit more on the IRA side of things, but probably at this point, covered calls would be kind of your way to go with just IRAs. But with margin accounts, we need to kind of, we need to think about on a margin account how we can make some regular steady income. Okay, so how does that seem, guys? How does that how does that seem to everyone? Are we kind of seeing how those numbers work? So remember, again, especially for an individual account, or sorry, I keep saying individual account, but especially for a margin account, this is how we start to produce predictable income. Because that's what we want, right? We want predictable income. We want some amount where I can say, okay, my trading account's doing awesome, but where is the money coming from? Where's the money going? What's going on here? I mean, that's like the story of my bank account for, my family. My wife told me the other day, she teaches dance, and she said, I'm gonna go spend this amount of money on the family. I said, I have a check coming in from dance and I want to buy this little thing for our house or whatever with my money. And I said, oh, that sounds terrible. You worked really hard for that money and it just goes right out the window, just like that, in exchange for something. I said, how does that feel? And she, of course, was picking up my heavy amount of sarcasm. It's a terrible gig. But I'm not a martyr for the cause. I try to spend at least $50 a year on myself. So, I'm well taken care of, but it's, where does this money go? Right. So that's where we want to start kind of honing in a little bit and saying, okay, not only is my account growing, but I can start to count on as much as we can count on in the stock market, but I can start to count on somewhere in the vicinity of $1,000 a month, $1,500 a month, whatever, right? We can start to say, I can plan on an amount in that vicinity to be coming into my account monthly because I own this stock and because there's a fairly predictable amount that's going to come from the shares of stock that I own. Keep in mind, if this stock keeps going higher and the option premiums end up going higher and the stock is appreciating, it's great. It's amazing. And there may even be a strategy in there. I'm still thinking through all this, where on larger accounts, we can have twice as many shares as we're selling options on. So when we get to that situation where we have to liquidate our position because we just can't get out of a good short call situation, and we're still left with some of the stock at that original price, and we can still keep our break-even price lower. It's still in the works. But these are just the basic numbers that we need to, these are basic numbers that we need to be thinking about and kind of starting to steer our brains towards. Okay. I hear you, Aris. My finance committee's, there's a lot of red tape there. Lots and lots of red tape for sure. So, do you guys have any questions, any comments? How does everybody feel about that? Do we feel okay about creating some predictable, semi-steady amount of income on a monthly basis? Okay, good. Thank you. Aries, that's a good point. What about diversification? In the words of Warren Buffett, diversification is for people that don't understand the market. No, I don't know. That's what he used to say, but it's a good point. And I, of course, think diversification is great, but keep in mind, and it's true, right? It's very important to be diversified for that steady income side of things. But remember, our worst case scenario, right, is that the stock that we own, hopefully they don't go out of business, but the stock that we own goes down. We can still continue to sell strangles on stock we own. We can continue to keep those strikes $2 away above and below. If I own the stock at $25 and it's trading at $20, yes, I am in a little more of a risky situation if the stock gets called away, so I have to be more aggressive about monitoring my short call. But in this kind of scenario, we can still do income producing trades. Now, obviously, we don't want to see, the stock that we're in go from $20 to $3. That would be a problem. And that's, there's I don't really believe that there's any, no risk situations in the stock market. So, this is in exchange for having to, turn in TPS reports and, deal with 50 employees or whatever. That's a risk we take, right? We put in an hour 3 times a month, and we put these trades on, and we let it rock and roll. I'm glad you got the TPS report movie quote there. So, well, Lenny, remember, the higher volatility is going to give us the better option premium. So it's really better that we have more volatile stocks for the volatility, right? For the extra option premium. Because remember, it's not ultra important that the stock only goes up and that it does not go below the price that we own it at. That's not the most important thing, which is kind of strange to think about. So if a stock is super volatile, do I want to do this I think the question to really think about for all of us, Lenny, and I'm glad you bring that up. It's not so much as the stock super volatile. Is it a volatile industry, right? Is it a sector that is crazy? Do we want to be doing this? Do we want to be putting all our eggs in one basket on an electric car stock, on a Tesla, on a workhorse, on a, any one of those? No, definitely not. This, I do like this much more in kind of the growth or excuse me, the value sectors. I wouldn't do this so much with tech stocks and other things that are crazy, right? That are all over the place. Exactly, Aris. I mean, volatility does mean that there is going to be, and so the volatility in the aspect of a volatile sector, yeah, I'm going to kind of stay away from that. But volatile stocks, I don't mind that so much. And there's a bit of volatility in some of these ones we're trading in X and CLF and so on, but they're certainly not like Tesla and the big growth stocks, right? So I wouldn't do it on those ones, but I would certainly do it with the higher implied volatility, option speaking, than just the volatility on the stocks. Yep. Okay, how does that sound? Anyone have any questions? I think we can probably wrap it up around this point. You guys feeling okay about that? Any thoughts, any questions, anything unanswered? I will give you some time to write those questions out and let me know if everyone is on board with that. Boy, the dang VIXY. Where is VIXY? Obviously not in a crazy enough place here. I mean, but the VIXY is down and the VIX is down. We just, we got to get a lot of volatility to get that VIXY going. And that was the whole purpose of the trade in the first place. But I was honestly, I was planning on the zombie apocalypse far sooner. And my timing was a little bit off. Nobody has been trying to eat my brains yet. So I guess we just wait. We'll make money on VIXY. We'll make money. I mean, I can just literally guarantee that, but it's going to be a stinker for sure. Janae, I also found a tax advantage because if capital gains and we have accrued capital losses from the past, so the income is tax-free. Ooh, okay, good. XLF, yeah, XLF, XLK, some of these ones are, are interesting and decent to watch. But, keep in mind, guys, why in the holy smokes does this thing keep going back? Keep in mind that we do have some good exposure in the save. We do have some good exposure here. How's Key doing? I mean, look at Key. What did we expect Key to do? Break out, maybe pull back a little bit. We're going to buy some call options, but Key is doing amazing, right? It's just doing, I mean, couldn't be happier. So Key's doing great. But yeah. Yeah, that's right. The government's happy to shell out, a couple of trilski to keep the VIX down. But when they step back and they say, hey guys, interest rates have gone from 0.0% to 0.1%, the market's gonna wet the bed, so to speak, and it's just gonna be craziness. But I read when you're Amazon or Apple, I read Amazon and Apple make about $700,000 a minute, right? 24 hours a day. When you're making that kind of money and tax goes from, 21 to 28%, for corporate tax, that 7% difference is pretty massive at $700,000 a minute. So, it's a big bill. Okay. All right, guys, that's it for me. Thank you for being on. That's right. Poor Bezos and his $190 billion fortune. It's fine. It's fine. Thanks, Lee. Hope your back's doing well. Hopefully the doctor visit went well for you. All right, guys. Very happy to be with you guys. Hopefully this is some helpful information. Take care. Have a wonderful evening, and we'll see you guys all back here Friday morning. It will be too long. I think I'm going to turn the camera on Friday morning. Are you guys going to be okay if I'm in a robe or something? Will that be all right with everybody? All right. We'll talk about it tomorrow. Thanks, everyone. Have a great evening. We'll see you guys back here Friday. Take care, guys.